Ladies and gentlemen, good day and welcome to the Q4 FY-25 earnings conference call of Aditya Birla Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Ms. Vishakha More, MD and CEO, Aditya Birla Capital. Thank you and over to you.
Good evening everyone and welcome to the earning call of Aditya Birla Capital for Q4 of FY-2025. Joining me today are senior members of my team, Bala, Rakesh, Pankaj, Kamlesh, Mayank, Pinky, Vijay, Ramesh and Dee. I will cover our strategy, financial and business performance, and Vijay will cover key financial and business highlights, followed by a discussion on performance of our key businesses by our business CEOs. The economic environment remains volatile due to recent tariff measures and geopolitical tensions in the region, which pose uncertainty for growth. During this turbulence, bond yields have softened and crude oil prices have fallen. CPI inflation has cooled significantly and RBI has reduced repo rate by 50 basis points along with a change in the stance from neutral to accommodative and has also taken various measures to improve system liquidity and stimulate growth. At Aditya Birla Capital, we continue to focus on driving quality and profitable growth by leveraging data, digital and technology. We follow a customer-centric approach to build deep understanding of the needs of our customers and provide them simple and holistic financial solutions in a seamless way. Prudent risk management practices form the bedrock of our approach, which has enabled us to protect capital and deliver risk-calibrated and sustainable returns across our businesses. We also continue to strengthen our omni-channel-based distribution network. Before we talk about financial performance, I am pleased to announce that we have successfully completed the amalgamation of Aditya Birla Finance with Aditya Birla Capital following all requisite approval. The appointed date for amalgamation is April 1, 2024 and effective date is April 1, 2025. Aditya Birla Capital now has two business segments. First, the NBFC lending business and second, the investment business through which it will continue to hold investment in all its subsidiaries and associate businesses. This marks a significant step in our transformative growth journey, increasing our strength and agility as a unified larger operating entity. With a simplified corporate structure, we now have a better access to capital to drive operational synergies, long-term growth and enhance value creation for all our stakeholders. Coming to the financial and business performance. 1. Growth and profitability. During Q4 of FY25, the consolidated profit after tax, excluding one-off items, grew by 24% sequentially and 6% year-on-year to 865 crore rupees. And the total consolidated revenue grew by 29% sequentially and 13% year-on-year to 14,138 crore rupees. For FY25, the consolidated profit after tax, excluding one-off items, grew by 8% year-on-year to 3,142 crore rupees and consolidated revenue grew by 20% to 47,369 crore rupees. In our NBFC business, the disbursement increased by 28% sequentially to 19,522 crore rupees in Q4 of FY25. The NBFC portfolio grew by 20% year-on-year and 6% sequentially to about 1.26 trillion rupees. The secured business loans to SMEs grew by 28% year-on-year and 7% sequentially. The corporate and mid-market portfolio grew by 27% year-on-year and 6% sequentially. The unsecured business loans to SME grew by 10% year-on-year and 8% sequentially. We have highlighted in our previous quarter's earnings call that given the early warning signals and challenges in the operating and macro environment, we had calibrated our sourcing from certain digital partners and reduced our exposure to smaller ticket size personal, consumer, and unsecured MSME loans. This approach has held us in good stead. Our portfolio quality continues to remain robust, with credit cost improving by 22 basis points year-on-year and 15 basis points sequentially to 1.21% in Q4 of FY25. Gross Stage 2 and 3 loans declined by 71 basis points year-on-year and 47 basis points sequentially to 3.78% as of March end. Our gross stage 3 PCR was 45% at a similar level compared to the previous quarter. We now believe that the operating environment has stabilized. In the personal loans and unsecured MSME segment, we are focusing on strengthening our internal sourcing channels and acquiring customers through our branches, ABCD app, and ABG ecosystem. Our ABCD app continues to scale up well and contribute about 5% of the personal loans disbursement in March. We have seen the disbursement in the personal and consumer segment grow by 4% sequentially to more than 3,000 crore rupees in Q4 of FY25. Further, we are also looking at collaborating with few marquee digital platforms. In these arrangements, while the sourcing will be done by the partners, the underwriting fulfillment and collections lie with us. We have also strengthened our retail and SME products, underwriting, sales and distribution teams. We believe that these actions will help us to grow our personal and unsecured SME loans and gradually increase the mix going forward. The profit after tax of NBFC segment grew by 11% year-on-year and 9% sequentially to 652 crore rupees in Q4 FY25. The ROA of the NBFC segment increased by 15 basis points sequentially to 2.25% in the current quarter. For FY25, ROA of the NBFC business was 2.27%. Going forward, we remain confident of growing the overall portfolio by CAGR of 25% over the next 3 years. Further, we expect the ROE to expand gradually, mainly driven by expansions in margin, improvement in productivity, and change in the product mix. Coming to our HFC business, we have created a full-stack franchise focused on both prime and affordable segments. In Q4 FY25, we continue to deliver on the strong growth momentum and gain market share as seen in the previous quarter. I am delighted to share that we have crossed the monthly disbursement rate of 2,200 crore rupees in March. This has resulted in our HFC AUM growing by 69% year-on-year to more than 31,000 crore rupees. The credit quality in HFC portfolio is among the best in class, with stage 3 loans declining by 33 basis points sequentially to 0.66%. We have made significant investments in distribution, data, digital, and emerging technologies to sustain the growth momentum in the future. The ROA of HFC business was 1.46% and the ROE was 11.03% in FY25. Going forward, we expect the current growth momentum to continue and gain market share. As the portfolio scales up further, we expect the operating leverage to kick in and ROA to improve significantly. Our aim is to achieve an ROA of 2% to 2.2% in the next 8 to 10 quarters. Moving on to asset management business. Our mutual fund average AUM grew by 15% year-on-year to about 3.81 trillion rupees in Q4 of FY25. We have seen a positive momentum in sales driven by improved investment performance and strong engagement of our sales teams. This has resulted in our market share improving by 6 basis points sequentially to 5.66% in the current quarter. We added about 27 lakh portfolios during the year and our total investor folios crossed 1 crore as of March end. Our monthly SIP flows grew by 5% year-on-year in March to 1316 crore rupees, and we added more than 5.4 lakh SIP accounts in the current quarter. The profit after tax grew by 19% year-on-year to 931 crore rupees in FY25. Moving on to our insurance businesses. The growth in the life insurance business continues to remain strong. We are the fastest growing player with an individual first year premium growth of 34% year-on-year in FY25. Growth was strong across banca and proprietary channels. We continue to be in the top quartile in the industry in terms of 13 at 61st months persistency. Post applicability of new surrender guidelines from October, we have taken steps to realign our commission structure, make changes in product pricing, and increase rider attachments to mitigate the impact of the new surrender guidelines. We are happy to share that these changes, along with the high quality of business, have helped us to achieve a healthy VNB margin of 18% in FY25. In absolute terms, VNB grew by 17% year-on-year to 818 crore rupees in FY25. Going forward, we are confident to grow the individual FYP by CAGR of 20 to 25% over the next 3 years and expand the VNB margin to more than 18%. In the health insurance business, we continue to be the fastest growing standalone health insurer. Our gross written premium grew by 33% year-on-year, driven by our differentiated health-first model and data-enabled approach towards customer acquisition. Excluding the impact of multi-year guidelines, the growth in GWP was 42%. Our market share among Sahis has increased by about 140 basis points year-on-year to 12.6% in FY25. Our combined ratio improved from 110% in FY24 to 105% in FY25, and I'm delighted to share that we have achieved a break-even for the first time in FY25. But for the change in the regulatory guidelines, we were on track to achieve a combined ratio of 100% in FY26. However, our endeavor still remains to achieve a combined ratio of 100% at the earliest. Going forward, we will continue to grow our business driven by our differentiated health-first model and gain market share. 2. Omnichannel architecture for distribution. Our omnichannel architecture allows customers to choose the channel of their choice and interact with us seamlessly across digital platforms, branches, and VRMs, fostering engagement and loyalty. Our D2C platform, ABCD, went live about a year ago. It offers a comprehensive portfolio of more than 25 products and services such as payments, loans, insurance, investments, and helps the customer to fulfill their financial need. ABCD has witnessed a robust response with about 5.5 million customer acquisitions till date. Our comprehensive B2B platform for MSMEs ecosystem, Udyog Plus, continues to scale up quite well with 2.3 million registrations. It has reached an AUM of more than 3,500 crore rupees in less than 2 years of its launch. Udyog Plus now contributes about 21% of the disbursement in the unsecured business loan. ABG ecosystem now contributes about 50% of the disbursement on Udyog Plus. We had around 1,623 branches across all businesses as of March end. We are focused on capturing white spaces and driving the penetration into Tier 3 and Tier 4 towns and new customer segments. About 60% of our branches are located across more than one ABC 250 locations. Going forward, we will continue with our approach of driving quality and profitable growth. Now, I request Vijay to briefly cover the financial performance of our key subsidiaries for the quarter. Over to you, Vijay.
Thank you, Vishakha, and good evening, everyone. Vishakha covered the consolidated highlights, and I'll cover the standalone financials of ABC and the key business highlights of each one of our businesses. During Q4 of FY25, the standalone profit after tax of the merged entity, excluding one-off items, grew by 6% year-on-year to 654 crore rupees. For FY25, the standalone profit after tax, excluding one-off items, grew by 15% year-on-year to 2,714 crore rupees. The Tier 1 capital ratio of the merged entity is 15.93% and total CRR ratio is 18.22%. Standalone return on equity adjusted for investments in subsidiaries and associates and excluding one-off items is 14.2% in Q4 FY25. In our NBFC business, the portfolio grew by 20% year-on-year and 6% sequentially to about 1.26 trillion rupees. NIM, including fee income, expanded by 7 basis points sequentially to 6.07% for the quarter. The credit quality of NBFC business segment continues to be healthy with a credit cost of 1.21% in Q4. Our housing finance business continues to see strong momentum. The loan portfolio grew by 69% year-on-year to 31,053 crore rupees. During Q4 FY25, we further infused equity capital amounting to 300 crore rupees in our HFC subsidiary, taking the cumulative infusion during the year to 1,200 crore rupees. This infusion was done to support the growth momentum and maximize our share of opportunities, which Vishakha mentioned earlier. Coming to our AMC business, the average AUM increased by 15% year-on-year to 3.8 trillion rupees in the current quarter, of which equity AUM was approximately 44%. Alternate AUM grew by 70% year-on-year to more than 23,900 crore rupees in Q4 FY25. In the life insurance business, our first-year premium increased by 34% year-on-year, and group new business premium grew by 23% year-on-year. The embedded value increased by 20% to 13,812 crore rupees, and the return on embedded value was 19.2% in FY25. In our health insurance business, our unique and differentiated health first model helped us to deliver a growth of 33% year-on-year in gross written premium during FY25. Excluding the impact of multi-year guidelines, the growth in GWP was 42%. Now I hand over to Rakesh to cover the NBFC business performance in detail. Over to you, Rakesh.
Thanks, Vijay, and good evening, everyone. The NBFC business grew by 6% quarter-on-quarter, taking the AUM to 1,26,351 crores in Q4. Profit delivery was strong, registering a 9% sequential growth in quarterly PAT. Over the last 3 years, we have doubled on both AUM and profit growth, which translates to a 30% 3 years compounded annual growth. This consistent and sustainable track record has been achieved by building a granular retail and MSME portfolio with strong customer focus and a disciplined approach towards improving asset quality. We aspire to be a top lender of choice for MSMEs. The AUM for business loans to MSMEs grew by 25% year-on-year, which is substantially higher than the industry growth rate for the year. This growth has come largely through scale of direct sourcing channels through our branches and building scalable digital sourcing platforms. The MSME segment comprised 56% of our overall AUM as of March 25. We registered our highest ever disbursement of 19,523 crores in Q4. 49% of this was contributed by business loans to MSMEs, and 87% of this disbursement was to MSMEs was secured in nature. We have continued to scale up sourcing through direct and digital channels, which now contribute 39% and 58% of unsecured and secured business loan disbursement respectively. Udyog Plus, our B2B platform, which was launched 2 years back, has scaled up and contributes to nearly 30% of the unsecured business loan segment AUM. With over 23 lakh MSMEs registered and a comprehensive product offering available on the platform, Udyog Plus will be a significant sourcing engine for MSME segment going forward. In the personal and consumer loan segment, FY25 was a year when we exercised caution by tightening our sourcing from high-risk segments. Post all calibrations undertaken, this segment has now stabilized at an AUM of 15,532 crores and is poised to growth here on. In fact, we look at our disbursement in this segment in Q4, we registered a 26% year-on-year growth with the share of direct sourcing improving progressively. As Vishakha mentioned earlier, the ABCD app contributed nearly 5% of the overall sourcing in the personal and consumer segment in March 25. Our focus will be to improve this share progressively. Further, we are exploring new partnerships with marquee digital platforms where we will continue to have end-to-end control from underwriting to collections, ensuring complete customer ownership. Thus, with multiple growth levers in place, I am confident that the personal and consumer loan segment will start registering calibrated growth going forward. In FY25, we were agile in responding to changing credit environment and leveraged the opportunity to scale up our secured business across segments. As a result, the overall secured AUM mix at the entity level has improved from 72% last year to 74% this year. The MSME segment contributes significantly towards the secured portfolio mix, where 83% of the overall MSME AUM was contributed by secured business loans, where the asset quality continues to be robust and amongst the best in the industry. We continue to operate at a very efficient cost-income ratio of 30.8%. Our OPEX to AUM ratio improved from 2.26% last year to 1.92% in Q4. And this has largely been driven by operating leverage as we continue to sweat new branches opened in the last 12 to 18 months. Our continued endeavor is to improve our asset quality, reflects in the sequential and yearly reduction in GS2 and GS3 by 47 basis points quarter-on-quarter and 71 basis points year-on-year respectively. The gross stage 3 loans are at 2.24%, which has declined 27 basis points year-on-year. As a result of our continued calibration in sourcing and improvement in asset quality, the credit cost has reduced by 15 basis points quarter-on-quarter to 1.21%. The credit cost for the year was at 1.31%, which is 19 basis points lower than the FY25 number, and is well within our stated guidance of 1.5%. As I mentioned earlier, that 74% of our loan book is secured. Our stage 3 book is well provided with a PCR of 45%. In Q4, we delivered our highest ever profit after tax of 652 crores, registering a growth of 9% quarter-on-quarter. Full year PAT grew by 13% year-on-year and stood at 2,501 crores. The ROA for the quarter was at 2.25%, which improved by 15 basis points sequentially. Moving forward, we expect all business segments to grow in FY26, with share of retail and MSME segments to improve. We will continue to leverage our proprietary digital platforms, which is ABCD app and Udyog Plus platform, and invest in branches to further improve share of direct sourcing. We expect operating leverage to play out from our investment in emerging locations. As we scale up, strengthen our capabilities, and invest in technology, our primary commitment remains to deliver sustainable returns in the upcoming quarters. With that, I will now hand over to Pankaj Gadgil to take us through the housing finance business.
Thank you, Rakesh, and good evening, everyone. I'm happy to share that we have continued to make consistent progress across all key aspects of book growth, asset quality, and profitability for 11 consecutive quarters now. FY25 has been a landmark year for us, underscoring the strength and momentum of our growth journey. We've crossed a significant milestone, achieving an AUM of over 30,000 crores. Asset quality has consistently improved over the last 10 quarters in a row. We have further strengthened our balance sheet by diversifying our liabilities, and business origination from within the ABG ecosystem has remained steady, contributed to 12% of our retail disbursements. Key highlights for FY25 are as follows. Disbursements for the full year stood at 17,648 crore rupees, an increase of 109% growth YOY. Q4 disbursements record highest ever quarterly disbursements of 5,820 crores, growing 98% YOY and 23% QOQ. AUM as of 31st of March 2025 stood at 31,053 crores, reflecting a strong 69% YOY and 16% QOQ growth. We achieved the highest ever PBT of 419 crores, marking an 11% increase YOY. Stage 2 and 3 assets reduced to 1.39%, an improvement of 152 basis points YOY and 38 basis QOQ. ROA is at 1.46% and ROE at 11.03% for FY25. This performance is underpinned by a strong foundation of governance, digital capabilities, data intelligence and technology. I would now like to provide a brief update on a few pillars of our growth. First, on portfolio quality. As noted earlier, gross NPA has improved both in absolute terms and as a percentage now at 0.66%, our lowest level since 2018. This reflects a reduction of 116 basis points YOY and 33 basis points QOQ. The improvement in asset quality has enabled us to comfortably maintain a stage 3 PCR at 55%, and additionally, over 95% of our collections are now conducted via our FinConnect platform, supported by robust collection propensity models. Secondly, moving to distribution, growth has been balanced across both prime and affordable segments, and we are now present in 18 states with 175 branches. The average retail ticket size stands at 29 lakhs, highlighting the granularity of our portfolio. Our active customer base reached approximately 91,200 as of March 2025, representing a 40% YOY increase. Next, focusing on digital reinvention, data and analytics, we've achieved 100% adoption of our digital platforms and analytic models. This has led to a significant reduction in turnaround times across the customer lifecycle. At the same time, we've seen a strong improvement in our net promoter score, which now stands at 79. We've deployed co-pilots leveraging GenAI capabilities to enrich the experience for both our customers and channel partners. These tools help with sales pitches, real-time credit and technical support, and query resolution, all in a more seamless and efficient way. As seen over the last 11 quarters, we've delivered consistent growth across segments, alongside continued improvements in portfolio quality and customer advocacy. Our focus remains on strengthening all key areas, from business expansion, digital reinvention to asset quality and customer experience, all while enhancing profitability in FY26. Thank you for your attention, and with that, I now hand over to Birla, MD and CEO of our asset management company.
Thank you, Pankaj, and good evening, everyone. I'd like to share the highlights of ABSL AMC performance as we present the AMC analyst call. At ABSL AMC, our overall assets under management on average basis, including alternate assets, stood at 4.06 lakh crore, reflecting a 17% year-on-year growth. Our mutual fund quarterly average AUM reached 3,80,000 crores, growing 15% year-on-year. The quarterly equity average assets under management stood at 1,69,000 crores, growing 11% on year-on-year. Our SIP book for March 25 stood at 1,316 crores, and we added about 5.43 lakh new SIPs in Q4 FY25. Our total investors' folio crossed 1 crore to touch 1.06 crores by adding about 27 lakh new folios in the current year. I am pleased to share that we have observed positive momentum in sales, driven by improved investment performance and strong on-the-ground engagement from our sales team. This also resulted in a quarter-on-quarter increase in our average AUM market share. On the alternate business front, we are continuously enhancing our PMS and AIF offering across both equity and fixed income to better serve the evolving needs of the HNIs and family offices. Following the receipt of the ESIC mandate from Government of India, we commenced management of debt portfolio, and its AUM stood at 7,450 crores on an average basis for the March ending 2025. And consequently, our PMS and AIF assets witnessed year-on-year growth up to 68%, rising from 3,075 crores to about 11,330 crores. Our offshore assets grew by 14%, from 10,545 crores to 12,070 crores, On the GIFT City platform, we successfully completed the final closure of the ABSL Global Emerging Market Equity Fund under the LRS scheme with an average AUM of $65 million, and fundraising is currently underway for other offshore funds which are launched under the GIFT City platform. Our passive business has grown with the total assets now reaching approximately 30,700 crores. We are also proud to serve an expanding customer base of surpassing 11.6 lakh folios. Our diverse product suite, consisting of distinct offerings, is strategically crafted to cater to the full spectrum of investment needs, ensuring we provide a tailor-made solution for every investor using the passive route. Moving on to the financials for the quarter. For FY25, we achieved a profit after tax of 931 crores, reflecting 19% year-on-year growth. Operating revenue is at 1,665 crores for the full year, 28% year-on-year, and total revenue for the full year is 1,986 crores, which is including other income by 21%. The operating profit before tax was at 941 crores, up 31% year-on-year, and profit before tax was 1,245 crores, up 23% year-on-year. For the Q4 FY25, our operating revenue was at 429 crores, up 17% year-on-year, and revenue was 501 crores, up 14% year-on-year. Our operating profit before tax for the quarter, 233 crores, up 20% year-on-year, and profit before tax is 305 crores, up 14% year-on-year. We are also pleased to announce the board had proposed a dividend of 24 rupees per share for the full year, as against 13% last year, which is reflecting 30 rupees per share, which is reflecting about 70% of the overall standalone profit after tax. With this, I will hand it over to Kamlesh Rao, MD and CEO of Aditya Birla Life Insurance.
Thank you, Bala, and good evening to all of you. Quick highlights of the life insurance business. The overall life insurance industry saw balanced growth in financial year 25. The individual first-year premium grew for the overall industry by 10% and for the private players by 15%. ABSLI for the individual life insurance business grew at 34%, contributed by growth across its proprietary and partnership channels. Along with this, we also expanded our market share by 68 bps last year. Proprietary channels of agency and direct combined grew at 33% in financial year 25, driven by better productivity as well as by capacity added last year. The partnership business grew at 34% with robust growth across all our existing partners, as well as the new partnerships in Bank of Maharashtra, IDFC Bank and Axis Bank, where we managed respectable mindshare in our first full year of operations. We now have 11 bank partnerships with a reasonable mix of large private sector banks, as well as regional private sector banks and 2 PSU banks. We added 3 banks last year and happy to share that we have recently entered into a new partnership with Equitas Small Finance Bank in financial year 25, which will begin business in Q1 of this year. During the year, we opened 60 new branches and invested capacity in new tie-ups to fuel our growth. In the next year, we intend to capitalize on this and grow largely on the back of enhanced productivity. The year also saw a healthy growth of 24% in the number of new policies sourced. In the product mix of the individual business, traditional and term business contributed 65% and ULIP was 35%. We are seeing a healthy growth in the annuity segment, with 7% of our business now coming from this growing segment. We launched 4 new products in the individual life insurance business and also launched a new product on our group platform, a specialized term plan for employees of our group term clients. The new products launched contributed to 12% of the individual business we did last year. In the group life insurance segment, the private industry grew by 5%, the overall industry by 1%, and the ABSLI registered a growth of 23% and resulted in our market share expanding by 112 basis points. Better growth was contributed by superior performance both in the fund as well as our credit life business. Our captive business attachments have grown significantly during the year. Our group AUM has now crossed 26,000 crores on March 25 with 15% growth and contributes to 27% of the overall ABSLI AUM. Our total premium for the year crossed 20,000 crores at 20,639, registering a growth rate of 20% over last year with a 2-year CAGR of 17%. This growth came from new business as well as our renewal premium growing at 14%. Our digital collections now account for 81% of our individual renewal premium. We continue to work on customer lifetime value, which is reflected in our upselling which reached 28% and helped productivity growth in both our proprietary and partnership channels. Our quality parameters have improved. Our 13-month persistency is at 88% and 61st month at 62%, placing us in the industry's top quartile. Our OPEX to premium ratio for last year was at 20.4%. Our assets under management now stands at 99,486 crores with a YOY growth of 15%. 24% of this AUM is in equity and balance 76 in debt. Happy to share that we crossed the 1 lakh crore AUM mark in April of 2025. More than half of this was added in the last 5 years alone. We continue to outperform in our investment performance in respective benchmarks across all three categories of equity or debt or even balance funds, either from a 1 year or a 5 year perspective. Our digital adoption across the various areas is demonstrated in slide number 47. 100% of our new business customers are onboarded digitally. 83% of all our services are now available digitally, which covers about 67% of our customer transactions. And our customer self-service ratio has now increased to 94%. We have made significant investments in AI and analytics in areas of sales training as well as customer experience, keeping both our internal employees as well as our policyholders in mind. As we move ahead, we continue to be best in class in our digital infrastructure across prospecting and onboarding in sales, underwriting, and customer service as well as claims. In terms of value and guidance for the future, our solvency continues to remain at a healthy rate of 188%. Our net margins for the year, as per our guidance, was 18% last year. We observed significant margin expansion in H2 due to a controlled ULIP mix, increasing top-line growth, and rider attachments. The reduction in margins from financial year 24 is largely due to a higher ULIP mix and lower interest rates during the year. As mentioned in the last quarter, we will continue to focus on our proprietary business encompassing agency as well as direct channels, with investments in value-accretive verticals and productivity increase across all cohorts. For our partnership business, we will continue to invest in our bank partners to increase our mind share and drive productivity across all partners. Our guidance is to achieve a CAGR of 20 to 25% for the next 3 years in terms of business growth. Whilst achieving this growth, we intend expanding our current net VNB margins to 18% plus, and in absolute numbers, double the value of our net VNB in the next 3 years time frame. With this, I hand over to Mayank, who will give details of the health insurance.
Thanks, Kamlesh, and let me now share an overview of the performance of our health insurance business. As I've shared in the past, ABHI has always been differentiated from other insurance players on account of its unique health-first model. And this model has helped the company grow faster than the market and deliver superior unit economics as well. In line with that, we had a milestone year in 24-25 in many regards, and it is my pleasure to state that the company has achieved its first full year of profit with 6 crores profit as per the new accounting regulation. As per the old accounting regulation, the profit for the year would have stood at 75 crores. This break-even in our 8th full year of operation is one of the fastest in the industry, with 2 times the GWP of the closest competition in the similar stage of their operation. The profit of 6 crores is in comparison to a reported loss of 182 crores in the previous financial year. A combined ratio for FY25, thus as per old accounting regulations, was 102% versus 105% as per the new regulation. And this is a marked improvement over 110% reported in FY24. This improvement underscores our continued focus on performance optimization and disciplined execution, even in a challenging regulatory environment. The recent IRDA guidelines on revenue recognition for long-term policies present an important regulatory shift. Whilst the unit economics of the business remain unchanged, the new accounting regulations impact the accounting financials in the short to medium term till we migrate to IFRS. On the revenue front, the growth momentum witnessed in Q3 continued in Q4, and we clocked a very strong 34% YOY growth, solidifying our position as the fastest growing SAHI player during the year. For FY25, we crossed the coveted 5,000 crores benchmark and achieved a gross premium of 5252 crores on the old regulatory mechanism, experiencing a strong 42% YOY growth. The GWP as per the new accounting norm stood at 4940 crores, a YOY growth of 34%. Our market share in SAHI in FY25 rose from 11.2 to 12.6%, an increase in market share by 138 basis points for the year. The high growth is driven by a very strong growth in our retail franchise, which registered an impressive growth of 44% for the year. The growth in retail is driven by all retail channels, with the proprietary channel, which now has an advisor count of 1.4 lakh agents, experiencing a 38% YOY growth. All our major banks and digital alliance partnerships, including Policybazaar, have also experienced impressive growth. In fact, we just added Bank of India today into our fold. The group business delivered an industry-leading core of 99% with 40% YOY growth. This core in group-based corporate business is driven by a sharp focus on profitability through careful customer selection and segmentation. We also lead the industry in the outpatient department business in the corporate space. We have one of the most comprehensive suite of retail products, and our flagship product, Active One, with 7 variants, continues to be a big success for us. Our differentiated health first model has matured further in the year. In FY25, 9% of our eligible customers earned good health-based incentives, which we call health returns, up from 6% in the previous year, reflecting deeper engagement with our wellness ecosystem. The outcomes for some of the intervened cohorts are also now visible. The percent of customers influenced by participating in healthy behavior has crossed 25% on an enlarged customer base. These customers continue to exhibit lower loss ratios and better persistency, which is shown in slide 58. Overall, this has helped us manage our retail loss ratio better than what we see in the industry. We've invested in building deep capabilities in managing customers with higher health risks as well, and even here we are seeing very positive improvement in the economics, including claims ratio and persistency. Our industry-leading claims settlement ratio of 96% and a customer NPS of 60 across 5 key engagement points reflects our commitment to prioritizing customer experience. To further enhance this and manage claims better, we have invested in state-of-the-art claims adjudication engine using AI and ML, and we're now processing more than 40% of our cashless claims using this engine. We continue to invest in our industry-leading Active Health app. The app now provides an opportunity for non-policy holders also to experience our comprehensive health and wellness ecosystem. And the YOY app download has increased by 125%, with the monthly active user base increasing by 48%. Looking ahead, we remain optimistic about the long-term growth prospects of the industry. Our differentiated model will help us in striving to continue to be the fastest growing health insurer. As we have guided earlier, we continue to be optimistic about reaching less than 100% core as per the old accounting regulation, and will endeavor to achieve this as per the new standard also very shortly. Thank you, and I'll now hand it back to Vishakha for a closing remark.
Thank you, Mayank, and we are very happy to take if there are any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We'll take our first question from the line of Avinash Singh from Emkay Global Financial Services. Please go ahead.
Yeah. Hi. Good evening. Thanks for the opportunity. A few questions. The first one is on NBFC margins. The fee income has seen a strong increase, but on the core, if we see the net interest income or the margins are still kind of a weaker, and that too particularly in the backdrop of a December quarter that was already pretty low. So can you please help us understand what is sort of keeping these margins at a lower level, particularly, even when the Q4 growth has come up from your SME segment, that has grown in Q4. So is it something, still the margins are under pressure? And going forward, given that, okay, your asset liability are pretty balanced as far as the fixed to floating are concerned, that means the rate cut benefit will not be material. So how the margin outlook appears at the moment, and what will sort of drive the going forward margin upward. So that's the question on margin. And second is, if I look at the NPA in that business loan unsecured, you have some 45% guaranteed by central government. That's fine. But the spike or increase is QOQ, it continues for last 4 quarters. And if we were to kind of again go look down further, probably from the disclosure, it seems that the government guaranteed part has a 6.5% kind of a GS3. So what is sort of driving this kind of a high NPA ratio in this, the book that is guaranteed by government? So, is some sort of the customer profile or some kind of underwriting filter, what's driving that? So that's on the business loan unsecured. And thirdly, on the growth side, yes, on 3-year basis, growth is very, very impressive. But if we look back this year, of course, one part was that, okay, on the personal and consumer side, there has been decline because of various issues. But, the growth at 20%, but out of that 20%, the 5% is kind of, portfolio buyout driven growth, close to 6,000 odd crore for the full year. 6,000 odd crore kind of. So disbursement will probably 2-3%. So what is sort of because you have been taking various initiatives, within Aditya Birla Group, ABCD, direct and all. Yet, what I would say that, okay, self-originated growth has been kind of a moderating. So again, looking forward, how will this growth will appear in FY26? Thanks.
So your first question was on the yield and the margins. So if you look at our yields for quarter 3 and quarter 4 is quite stable at 12.9, and the margins expanding from 6 to 6.07. And as we had mentioned to you in the last call as well, that this is on account of the change in the product mix. So our personal and consumer, which used to be almost 20%, 19-20% of our overall loan book, has come down to 12-13%, and that has impacted the yields. We were slightly ahead in terms of the market when, in terms of taking corrective action. We strengthened and we tightened our underwriting, and that's the reason. But if you see quarter 4, it's almost now stabilized, and we are poised to grow in this segment. So going forward, you will see expansion as this segment grows, the expansion in terms of the yields and the margin. So that's the answer of your first question. In the unsecured segment where you mentioned that we have there is an increase in the NPA stage 3. So if you look at the unsecured segment, it comprises of 3 segments. In fact, in a way, there is 20% which is supply chain business, 80% which is the term loans where we have business loans and small ticket unsecured loans. And looking at the stress in the industry, this we had tightened in terms of, and we had slowed down our sourcing. We have seen some amount of over the last 2-3 quarters, but if you see, almost 50% of that portfolio is backed by the credit guarantee and strengthening of the scorecard. Now, I think there is recalibration which has happened in that segment. Going forward, there will be improvement as we go along. And the reason why it looks elevated is because it does not get written off at 180 days, and that's the reason it keeps looking elevated. So that's because this is backed by a guarantee from SIDBI. So that was your question number 2. The third question was on the growth. So if you look at not only the last 3 years, almost 32% compounded annual growth, which we have demonstrated, and this year, in spite of recalibrating our personal consumer and the unsecured business, we have achieved a 20% growth year on year. And as we have guided that in the next 3 years, we are looking at doubling our loan book. So clearly, that's the kind of momentum which we are looking at going forward as well. In terms of your question on the portfolio buyout, that's a very small part of our overall. We are both on the selling side and the buying side. So we look at whatever the opportunity which is there in the market, we evaluate that, we assess that, and that's how. So net is between sale and buyout, I think the net book is very, very small. And it's, if you look at around 5-6% of the overall disbursement of 67,000 crores of annual disbursement, which we have achieved last year.
Okay, thanks.
Thank you. We'll take our next question from the line of Chintan Shah from ICICI Securities. Please go ahead.
Thank you for the opportunity. So, sir, firstly, on the NBFC, so there is some 60 basis rise in the unsecured business stage 3. So, what would explain this from 4.1 to 4.7?
I just answered that question, Chintan. Just answered that 4.1 to 4.7. This is clearly, if you look at the segment, which is supply chain, 20% is the short-term supply chain business, where the credit quality is pretty good. Then we have a business loan and the small ticket unsecured loans, where we had looking at the stress in the industry, and also we saw some bit of on the backdrop of leverage. We have tightened the underwriting, the scorecards and the policies, and this looks elevated because it does not get written off at 180 days the way we do our other unsecured segment, because this is guaranteed by the government and the SIDBI. So that's the reason why it looks elevated. As we go along, I think this should get corrected, and it should come in it should get normalized.
Sure. Sorry for the repetition. And also, 2-3 questions on the HFC business. So HFC, I think this quarter the capital adequacy ratio has around 14.3%. So what is the minimum threshold there, or will we be infusing further capital? So firstly on there, and so the developer book in the HFC business, so that has more than doubled on a YOY basis. So what are the typical yields here and the average ticket size, and what kind of developers are we dealing with? Because the growth looks quite robust, and the yields have declined. So just wanted to get some sense on that. Yeah.
So I think the first question, Chintan, you'll have to repeat and first answer the second question. The second question was towards the developers that you said.
Yeah, developers.
Yeah. So growth and disbursements, has been quite uniform. If you see retail also, retail has grown by 94% actually, and developer has decreased by 136%. So on both the sides, the growth is quite significant, and that is where the 109% growth, YOY. So that's the first, part of the question. The type of developers that we typically source, so it is a fairly granular portfolio between 280 to 300 developers that are there in the book. So the average exposures that we'll have on developers will be in the range, the ticket size will be in the range of about 25 to 30 crores. That's the, ticket size. So typical projects, where the cost of construction will be anywhere between 200 to 250 crores will be the typical developers that we'll be financing. So that's how it is. And I think last time I had also spoken about this, that in this business, like you rightly said, I think monitoring is very critical. And, we do this with a platform that we have launched. It is actually, I have not seen many companies using it, but we have created one which is called FinCF, and that platform allows our developers to undertake many of the activities on their side digitally, and most importantly for our teams to also monitor the portfolio both event based and also frequency based. So I think this is how we are monitoring the portfolio and monitoring the growth. Could you repeat the first question? I think you said something on 14.3. If you could add.
Sure. Yeah. So I will answer. And on the yields also, I think if you would just help us with what would be the typical yields in the developer book?
So developer book, the yields are anywhere between 30 to 13.25. That's the yield that is there for the developer.
13 to 13.25.
That's right.
Sure. And so on the retail portfolio, what will be the yield, the blended yield?
It will be about 10.25.
10.25. Sure. And so firstly, I had mentioned on the capital adequacy ratios, that is around 14.3%. So what is the minimum threshold or the regulatory requirement, and so how much capital are we looking to infuse in FY26? Yeah.
So total CRAR requirement is 15%. On that, we have 16.54%. And during the year, we've infused 200 crores. And internally, while the regulatory guideline is 15, I think, we are comfortable, in that range of between 16 to 17. That is the internal guideline that we have.
We really looked at Vijay here. The tier 1 CapEx is 14.3 and we have sufficient headroom to raise even subject from the market, and whatever growth capital in the HFC will be required during the next year, we'll also support from ABC, from the operating and the holding company. So no worries on the capital requirement of the HFC for meeting the growth requirements.
Okay. And just lastly, on this ROA front, we have mentioned that ROA will inch up to 200 to 220 for the next 8 to 10 quarters from 146 currently. So what would be the key drivers? Would it be OPEX or yields or credit costs? Just could you throw some light on that? Yeah, that's it from my end.
If you see the financials which have been provided, you will see that the NII is 5.07, the OPEX to average loan book is 2.94, and the credit cost is 24 basis points. That is how the ROA today is 1.46. So the improvement in ROA will essentially come with operating leverage. So what is OPEX to average loan book, which is 2.94? The endeavor in the next 8 to 10 quarters is to reduce that by between 120 to 130 basis points. And this will naturally come, with the book, building and the plan, of the growth which is there. Credit costs will be range bound. Anyways, it is at 24 basis points. So in my assessment, they will be in similar range. In fact, the NIMs from 5.07 may come down by 30 basis points. So the net would be 100 basis points, difference, 130 less 30, and that's 100 basis points. So post-tax, we should be able to get about 60 to 70 basis points additionally over where we are. So that's the broad calculation, of our ROA, which Vishakha mentioned in our opening.
Sure. So just to follow up on this, so basically the OPEX has almost increased by around 50%, 47% odd in this year for the HFC business in FY25. So it means the large front loading of the expense or the initial capex has been done, and the productivity and efficiency should follow, right? Is that a fair assumption?
That's right. You captured it correctly.
Sure. That's it from my side. Thank you for answering all the questions. All the best. Yeah.
Thank you. We'll take our next question from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for taking my questions, and good evening, everyone. Firstly, on NBFCs, just trying to understand, sir explained earlier that as the mix of PNC, personal and consumer, in the loan mix improves, we will see yields improve and margins improve. So just trying to understand over the next maybe 1 to 2 years in a declining rate environment, while one tailwind will be improving proportion of PNC in the loan mix. How are we placed on the liability side, and how will that impact margins is one thing I wanted to understand. The other thing is on NBFCs, I think we've guided for again this year doubling the loan book over the next 3 years. So just trying to understand, will the existing product suite suffice, or are there any newer products that you would look to pilot to double this AUM, this doubling of the AUM over the next 3 years?
So I think I will take your second question first, because I think doubling of the loan book, the way we have the entire range of product on the personal consumer side and also in the MSME side. We might look at 1 or 2 more products, but the way we are looking at, we want to sweat our existing branches, the branches which we have set up in the last 12 to 18 months, and also branches which we will open in the next 6 to 12 months. So that, and also the digital assets which we have created both on the personal and consumer side, and for MSME side, the Udyog Plus which we have set up. So we want to sweat up these the channels, the platforms which we have created, and also the productivity as if you look at these branches, a lot of branches have been opened in the last 12 to 18 months. I think the productivity should get improved, and so that's how we are looking at doubling. And that's the reason the guidance is for 3 years in terms of doubling. There might be a slowdown looking at the environment the way we did it in the last year. Looking at the environment and the leverage going up, we really recalibrated our strategy for unsecured loans. But going forward, in the next 3 years, we are quite confident that we should be able to deliver the numbers within the range of products which we have, with addition of few products and just setting out the infrastructure or the platforms which we have created. What was the first question? Cost of funds, if you look at our liability, our borrowing is 65% is floating and asset is 71% floating. So in a way, it's very, very balanced. In terms of as we grow personal and consumer segment, short-term unsecured loans, primarily they are secured in nature, and as we get these are fixed in nature. As we keep getting the benefit on the cost of funds and it will get locked in for 2-3 years, our margins should expand, and also the product mix. More than I think the product mix only should help us improve our yields and margins. So that's how we are looking at margins going forward.
Thank you. And just a related question, while we are at around 12% personal and consumer loans in the mix, and like you said earlier, at the peak we were at around 20-21%. Is the idea, while we go in a calibrated manner, the intent will be that over the course of time take it back to 20%, and then, I mean, how would the interplay be on the ROAs on the HFC? I think we guided for 2 to 2.2% over the next 8 to 10 quarters. How should we look at ROAs in the NBFC business?
So the stated, I think, guideline or whatever which we have in terms of the product mix is 75% of our loan book has to be retail and SME, and 25% is on the corporate side. That's how that should help. Within that, if you look at retail and SME, as you rightly mentioned, personal and consumer can go to around close to 20%, and unsecured business will again grow. So both these segments growing and the margins improving, that will expand our ROAs. In terms of guidance on the ROA, we will, I think, wait and see how the next couple of quarters goes, and then we should be able to. But we are looking at expanding the ROAs from here on.
Got it. And then the last question that I had was on our HFC business. So I mean, just trying to understand this principal business criteria, which says that 60% of the company's total assets should be dedicated to providing finance for housing. Where are we placed in the PBC in our housing business? And just trying to understand in terms of mix, we have seen, I mean, over the last 1 year, very good traction on the CF side, the construction finance side. So maybe over the next 2 to 3 years, how are you looking at this mix evolving, particularly the CF side and the affordable businesses that we have?
Right now, on the PBC, there are two criteria. One is, on the overall HL. So there, we are placed, we have to be at 60, we are at 61.1. When it comes to individual housing loans, it has to be, higher than 50%. We are 52.4% on that side. So the idea is that, of course, even in the developer financing, if the financing is for residential projects, it gets classified as HL on that side. On the mix, right now we are at a mix of 14.3 for the CF business, and prime is at about 47 and 38 is affordable. The mix is going to be in that similar range only. It will be that range of 45 to 47 of prime, 30 to 40 of affordable, and between 14 to 15 of developer. That is, the percentage. And the objective, obviously, is to leverage the opportunities which are coming in, on both the housing and on the LAP side, and ensuring that, we are ahead of the regulatory percentages on PVC.
Got it, sir. This is useful. And if I can just squeeze in just one last question. We've done exceedingly well, almost a 70% kind of a YOY growth in our housing business. Just trying to understand, I mean, are we a little aggressive in the market, especially when it comes to housing loans, and particularly in those projects where we had given construction finance. What I'm trying to understand is, usually kind of when we look at other housing finance companies, more often than not, the LTVs are in that range of 75 to 80%. For us, are those LTVs higher than our peer set? Is that also something which is helping us get faster growth?
So, I think the first question is that, we've been always talking about in the last almost 6 to 8 quarters that, we have built capacity in the housing finance business. So, building capacity and the platforms that we have earlier spoken have improved the productivity of teams. So, significant increase in capacity, and that also shows in the OPEX, which was earlier brought out by one of the, other questions that I answered. So, it's a function of capacity and productivity that, has helped us in growing, this business. On the LTVs, there are, of course, clearly, there are regulatory guidelines around LTV, so, there is not too much of a play which is available, on the story. We have seen the last 2 years, on the way LTVs have progressed, and I can, give you comfort that, our overall LTV, if I say all cohorts put together is in between 50 to 60% in 24 and 25. So we have not seen a change. The growth is coming on the back of capacity, productivity, and 12%, of our disbursements, we've been saying, we've been able to leverage the EPC, EPG ecosystem as well. That gives us an opportunity also to improve our growth versus the competition in the market.
Got it. This is very, very useful. Thank you very much for patiently answering all my questions. I wish you and your team the very best.
Thank you. We'll take our next question from the line of Sameer Bhise from Diamond Asia. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a good set of numbers. Just wanted to ask on the flow rates on the unsecured business loans. Rakesh, could you comment it? While we understand that headline GS3 is slightly higher, but some understanding on flow rates would be helpful.
So, can I just come back on this flow rate for business loans which you are talking about?
Yeah, the unsecured.
I can come back to you on this.
Sure. And secondly, how should one think on credit costs incrementally? I mean, you have mentioned that the environment has improved and you are more confident to grow on the unsecured piece. Would that mean, obviously it means a lower credit cost for next year. So how should one think about it? That's all from my side.
No, so on the business loan, the earlier question, the flow rate is 0.8. So that's how it's stacking up quite well, and we should see some improvement there. In terms of your question, in the
It's credit cost.
Credit cost, if you see in a difficult environment also, but last year when the unsecured stress was seen in the industry, we have reduced our credit cost from 1.5% to 1.31%. Yeah, so we have clearly demonstrated that we had the agility to move away from low ticket unsecured where the customers were leveraged to move away from that and build our secured business. So we have clearly demonstrated that. We have strengthened our underwriting. We have put all the criteria in terms of looking at the leverage, how many. I think those are the inputs which have gone into the scorecard. So clearly, we are looking at sustained credit costs over the next year or so. We have been tracking the portfolio not only on the bounce rate, but the first EMI bounce, second EMI bounce, and tracking each and every cohort very, very closely. We have strengthened our collections infrastructure, preemptive telecalling for customers on collections. So I think a lot of actions which have been taken, and we are quite confident that post-calibration, and also we have cut out the higher risk segments from our underwriting and sourcing. So we have cut that out. And so we should be able to sustain the credit cost next year as well.
Okay, fair enough. And the flow rates that you mentioned, is it fair to assume that they have been largely stable?
They have been largely stable, yes.
Okay. Fair enough. Thank you and all the best.
Thank you. We'll take our next question from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, sir. Good evening. Just wanted to understand a little bit about the unsecured personal loan. You mentioned that last 1 year has been you've been a little cautious on this portfolio, and the share has come down from 17 to 12. So going forward, while you've indicated 20% over the next 3 years, but just wanted to understand its dynamics on yield. Let's say if we improve the share by 200 or 300 basis point in the coming year, what kind of yield this portfolio runs at, just to understand how much can it benefit on margins?
This portfolio runs at closer to 18-19%, and this should, I think, 200 basis point improvement in the product mix should help us expand our margins. And that's what I stated earlier. In terms of absolute margin expansion, I think we can just simulate that.
Sure. Thanks. On the coming to the funding mix, if I look at almost half of your borrowing is from bank, and if I include working capital, that's about 57%. So what percentage of this liability would be linked to repo, and what would be the other piece? Let's say MCLR. Is it 1 year MCLR or 6 month MCLR? If you can give some split of your borrowing.
Primarily, most of our borrowing from the banks is 3 months MCLR and 1 month MCLR, and not 1 year MCLR. So that's repo would be, I think, quite low in terms of closer to around 10% or so.
Sure. So coming to, let's say today we've seen a 50 basis point rate cut. Let's say this may take for banks to reprice. It may take about 6 months to 9 months on the MCLR front. So as and when it happens, so can we expect, let's say, this half of it at least flowing through in this year? Your cost of funds, at least from the bank borrowing side, half of the rate cut benefit flowing through in FY26. Is that a fair assumption?
As the rate comes down, yes, the benefit should come to us. But apart from the bank loans, I think we have, the NCDs, the money market which we borrow from. I think that is at a slightly lower cost. So that's another, the short-term borrowing, because we also have short-term assets on the supply chain and on the consumer loan side. So there are many avenues to improve our borrowing mix and reduce our borrowing costs.
Understood. And just final question, the merger with the holding company, is there any sort of benefit on either funding cost or maybe some operating synergies that you can speak about that can benefit us over the next 2-3 years?
Gaurav, on the part of the merger we had explained earlier also that funding, because we are anyways, ABFL was also AAA rated, and from CRISIL, ICRA, all the rating agencies, and ABCL is also AAA rated. So there won't be any benefit as such flowing out of the rating or something, but what definitely we have, it's a large unified NBFC now and an operating company with a better access to capital. Also, the larger benefit of the merger was on account of release of capital. So close to about 3,000 to 3,500 crore worth of capital got released, which was invested, and that has helped us to take care of at least 1 to 1.5 years of growth requirement. So I think that was the major benefit. Other than that, we've always operated on a lean model at the holdco. So synergies will of course be there in terms of the horizontals that we carry at holdco, but largely the benefit will be of being a large unified operating NBFC or direct access to capital, and also the capital release that we explained.
Understood. Perfect, sir. Thank you so much, and all the very best.
Thank you. We'll take our next question from the line of Nidhi Jain from Investec. Please go ahead.
Thanks for the opportunity. First question is on the ABCD app. Can you share some data around customer engagement? What is our monthly active users? and some business data as well. What is the quantum of disbursements that we have done? What is the quantum of mutual fund AUM or life insurance premium, health insurance premium that we have generated in FY25 from the app?
So currently, we are tracking the number of customers that we've onboarded, and of course, we've also spoken about the number of BPS that we've had, on the customers who have experienced the app. As we've just completed a year of the launch, last year we launched it on 16th of April. I think in the subsequent quarters, we'll come up with the GMV numbers and also the questions that you are asking.
Just to give some clarity here, Nidesh, for now, you can say that the origination on the personal loan on the NBFC side and having created the journeys for the personal loan, a large contribution to the housing loan and also to the asset management business in that order. And we are also looking at growing the insurance and the rest of the businesses also on the app. And as Pankaj said, the numbers we'll be able to share in the subsequent quarters.
Sure. So you mentioned 5% of personal and consumer loans have come from this app. Can you quantify in rupees crore?
100 crore run rate per month, Nidesh. I think we'll keep it there. Okay.
Sure. Secondly, can you share stage 1 and stage 2 PCR movement from FY24 to FY25 for NBFC and housing finance business? In percentage term, what was the stage 1 and stage 2 PCR?
Nitesh will come back to you on this.
Sure. And lastly, in the life insurance business, can you share the reason for positive operating variance and positive assumption change variance for FY25?
So positive operating variance is largely on account of better experience in lapses and contribution of group business profit. So that's largely the contribution coming on the operating variance side. On the assumption variance, basically persistency, lapse in some of our products, specifically non-par, and also on portfolio, our mortality experience has been better. So typically what we do is, we look at consistency of that variance that we see over a year or two before actually taking the benefit of that. So we got some higher on account of assumption variance, but operating variance for us has always been positive over the last few years. So a combination of both of this is the explanation of your operating variance as well as the assumption variance difference.
Sure. So what would be the margin expansion because of the assumption changes for the current year?
So basically, if you look at the large contributor still comes from the net VNB of the portfolio. If you're asking me in the bridge, then I'm saying we would have got roughly about 100 basis points extra on account of the assumption variance change.
Sure. Thank you. That's it from my side.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to Ms. Vishakha Mulye for closing comments. Over to you, ma'am.
Thank you so much for joining us. And if there are any more questions, all of us are available. We will get in touch or you can contact any of us. Thank you.
Thank you. On behalf of Aditya Birla Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.